Hey everyone, it's Daniel here from InfoS. Hope you're all doing well. Just wanted to go over this article that came out over the weekend. I'll put a link in the description for you to read up on it. But basically, it says that Goldman Sachs is setting to cut about 3,200 jobs because of the weak outlook that they see in the economy for 2023. So, this is very interesting because we're starting to see now banks starting to lay off their workers, right? First off, we started with the tech companies, and also we had the Amazon layoff of 18,000 employees as well last week. And now we're seeing Goldman Sachs, a bank that is listed in the Dow Jones, a very reputable, safe bank, also looking to cut employees due to maybe overhiring, due to weak economic outlook that they see, and so on. So this news is basically the beginning of what layoffs are to look like throughout the year, right? What the signs of the cracks that we've been talking about here on the channel, when we look at certain economic data, when we look at the jobs report, when we talked about the ISM manufacturing data and all of that, it's starting to show and creep into these companies, and these companies are starting to, the effects of the job layoffs are starting to affect and spread into a lot more sectors. Now, of course, some sectors may be more resilient than the other, especially during holiday seasons. Probably the hospitality and leisure industry definitely still needs a lot of labor, especially during the Christmas times. But you can probably see that change, especially in January, as things start to slow down, and especially as we start to hear more of earnings come out from companies. Don't forget that we also have earnings coming out for a lot of companies, and it's expected to be weak. And it's expected that going forward in 2023, that more of the profits and revenues are expected to be deteriorated because all the rate hikes that we done in 2022 and we're starting to see the effects of that in 2023. And the most important thing is the Fed. The Fed is not done with its rate hikes and still going to continue to increase interest rates, maybe not at the same pace as what they did before, but at a 25 basis point rate hike. And some economists are thinking and saying that, hey, we could see maybe 5.5% or higher, and which could really shock the equity markets, especially if the wages and inflation doesn't come down to their mandate or to their goal, which is very likely to, which is not hard to think that that won't happen. It is very much possible that it can happen. We'll just have to wait and see what the data comes out as. Now, the other thing I want to mention from the NFP report that we got on Friday is very interesting to see, and I'll reiterate this again with all the job layoffs that are happening, especially with Goldman Sachs. It's very interesting to see that the full-time employment has come down, but the part-time jobs have increased. So you're seeing that as people lose the full-time jobs, they're transitioning into the part-time jobs. And if you also look on one of the reports in the NFP, the multiple job holders, basically there's a section in the report that talks about total multiple job holders, which means that people who are owning and having multiple jobs have basically increased to a very high level for in terms of this last report, in terms of December. And that number has increased by quite significantly because people who are losing their full-time jobs are probably getting part-time jobs and getting not one but two or multiple in order to bear with the inflation and the food costs and all their other expenses. So we're starting just this news from Goldman Sachs, the NFP report that we saw, and also on top of that, the household survey, which has shown that 6 months of jobs being stagnant is just the beginning. And companies don't go out and just, willy-nilly just decides all of a sudden that they're going to cut jobs and completely destroy their workforce. No, they like to see first what's happening currently, and what's expected to come, and if they really need to, then they will go out and cut the jobs. So this is just the beginning, right? Just because Goldman Sachs cut 3,200 jobs, you know, you can't expect that they could cut more jobs in the future. And they're going to make that decision, and many more companies are going to make that decision after seeing the after effects of data, the economy, demand, supply, etc., prices, and so on. So we could really see that maybe in the first or second quarter, maybe third quarter, maybe in third quarter of this year, when really things start to deteriorate in the economy, then you'll probably see more companies make decisions that, okay, we're not making sales like we had before, profits like we had before, we've overhired, let's now cut jobs. But they're not going to do it before the situation happens, because if they're wrong about the economy and the economy doesn't really deteriorate and they don't really lose their profits and sales, then they've basically messed up from trying to predict the economy. So they will do it once the result comes out, and maybe we will see that, who knows, first quarter, second quarter, third quarter, most likely probably second half of the year. We'll see what happens during that time. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button as well, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.